We're seeing somewhat of a correction in the private credit market. We've seen net outflows on the wealth management retail side through the private perpetual BDC structures. We have seen spreads widen out in the last 3 months by 100 to 150 basis points just in kind of regular way for direct lending.
Let's dive right in. Why don't we do quick intro, you, your firm, and then the area of specialty within credit that you focus on.
Hi, I'm Terry Moniz. I'm the co-chief investment officer of ICG Advisors. We're an $8 billion RIA multifamily office based in Los Angeles. As a co-CIO, I cover everything, but we focus very heavily on credit. We actually have credit products as well. So it takes up a big chunk of our time.
Todd?
Yeah, Todd Trabocco, Stepstone Group. We're an alternatives advisor and asset manager, and I'm responsible for the consulting side of the business in North America.
I am Jonathan Berger. I'm the co-head of credit for Third Point. Third Point now is a $25 billion asset manager, including the flagship hedge fund, structured credit, corporate credit, and an insurance company.
All right, let's dive in on where we are today. Talk about what might happen in the future later. As you look at this space, whether it's gated, confused, or otherwise, who wants to just start with painting the landscape of what you see in the markets today, fundamentally, pricing, valuation, everything? John, you want to start?
Sure. You know, I think that I'll start out with saying that we're seeing somewhat of a correction in the private credit market. We've seen net outflows on the wealth management retail side through the private perpetual BDC structures, but I wouldn't call it a major systemic issue. I do think it's created interesting investment opportunities. We have seen spreads widen out in the last 3 months by 100 to 150 basis points just in kind of regular way core direct lending. And if we look at situations where there's more complexity, like capital solutions, I would say it's a very diverse set of outcomes, and there's a lot of dispersion. I would even say that's the case in the liquid, non-investment grade credit market, and there's some similarities and overlap there.
When you look at the breadth of that, say, dispersion of spread and maybe some of the more complex stuff, give a sense of something that's tight, something that's wide.
Sure. You know, in terms of a middle market buyout, I'd say also it's important. It's not just about the spreads widening out. It's also about lower loan to values, so less leverage and more equity being put up, tighter structures, more covenants. And we're at the beginning stages of that. I'm not saying there's not been this wholesale change, but let's say a year ago, a regular way deal that could have been levered 4 to 5 times, 50% loan to value, pricing at SOFR 425. Today, that same deal, pricing SOFR 550, 575. But that change really occurred in the last 3 months. On the capital solutions side, you know, where there's more complexity, things were getting tighter, so they were pricing at 650, 700. Those deals, if a company needs capital today, 800 to 1,000, and maybe an equity component.
Todd, you want to jump in?
So I'll come at it from a different angle. There's been a lot of and the title of the panel is Gated and Confused, so that references what's happening in the retail market or the high net worth market channel. And when I talk to our institutional clients, they don't recognize the headlines. They read them and they understand that it's a structural issue. But at the asset level, they don't see the stress that one might extrapolate from the headlines. So obviously, there's, you know, things are okay. They're not great. They're okay. You know, we need to see how things shake out the SaaS apocalypse and the threat of AI. But in general, the managers that we see and the allocations that we see tend to be doing all right, with the caveat that we don't see the juicy pricing in some GPs that you're seeing that do what you do. we see somewhat thinner pricing in that.
Yeah, we actually see a lot of opportunity now because a lot of the marginal dollars coming into private credit was coming from retail high net worth space, and aggregating to big pools of capital through open-ended vehicles with that allowed some form of distributions or redemptions for managers. That marginal dollar is not going in now, which is creating some opportunity. These businesses we feel are going to die a slow death, or at least not be as active as they used to because they've got to fund investor redemptions and you can't be on the front foot. And that we think is going to create some opportunities. People are worried about SaaSpocalypse. That's actually a really interesting opportunity because there's been a lot of babies thrown out with the bathwater there. There's going to be a lot of software companies that are highly cash generative are probably going to need some kind of capital infusion later on down the road when they have to refinance. And that's a really great opportunity for credit managers to step in and provide capital to these guys because some of these businesses are going to be totally fine and won't be disrupted. Some of these businesses will benefit from the use of AI, but it's a pretty big opportunity set, and everyone is sort of painting it with the same brush now. So I think this is going to be a great opportunity to step in there.
So I'd love to pull a thread on a couple of things. Jonathan, you talked about retail slowing down, that channel, because of what's happened. What happens with the growth of private credit as a whole if the retail channel that so much of the volume has come from kind of slows because of the structural issues?
Well, there's actually, if you look at the flows into private credit, while there's been net outflows in wealth management and retail in the last quarter, there's actually probably net inflows into the asset class. So these private perpetual BDC structures maybe represent about 20%, but the bulk of private credit is still either in drawdown structures or SMAs with institutional investors. So I think that what it's going to do initially is we'll have probably more spreads widening out. I think there is what we talked about in terms of software exposure. Clearly there's software exposure, but it's less about software and more about AI disruption and what companies have AI. But that's across all markets. It's not just private credit. But I would say what it means is that we're going to probably continue to see spreads widening out. Private equity shops, who are the biggest users of private credit, are changing their economics when they look at these deals. The cost of capital is going up. They're putting up additional equity, so their returns are coming down. I feel like we're going to see a slowdown, but institutional dollars are continuing to flow in, not as rapidly as retail flowed in recently, but they are circling, and there's maybe a more of a discipline in how they're looking at their returns. They need a certain return threshold to step in at this point.
I mean, I think the growth of the private credit market was intentional. The government didn't want this stuff on bank balance sheets anymore. They wanted the risk in the hands of private investors that could take the risk and understood it. So it'd actually be really interesting to see now there's going to be lightened up regulations on the banks. There's going to be more lenient capital ratios that are required, and some of this stuff may wind up going back on the bank balance sheets again. So there may be a little bit more of a balance of who holds the risk, but the asset class isn't going anywhere, and it's probably going to moderately grow over time.
Todd, I mean, just go.
You're asking me to look at the crystal ball, are you? Is that what you're asking me to do? All right. So we all have different crystal balls, right? And so if you believe that private credit is a house of cards, that it's a new asset class, and it's just a bunch of hokum, then the answer is obvious. There will be a shakeout, people will realize they've been duped, and it'll go away. That's one extreme. That's not my crystal ball. My crystal ball is the opposite, and I'm a big believer in it. And I think the future will be positive. There will be a shakeout. GPs that are marginal, fund managers that are marginal and not very good will exit the market. People will lose money, sadly. But for the good GPs and the quality fund managers, I think that they'll prove their resilience, they'll prove their ability to generate returns. And I think once we go through the period of doubt and once we see a proof of concept, then I think that it'll continue to grow.
Yeah, we don't think there's a crash coming. We don't think there's a big blow up in private credit happening.
I didn't say you did.
No, I'm not saying you said I did. But I'm saying there's a lot of fear out there. We're talking about someone's son. Your son was asking about, what's going on in private credit? Should we be worried? We don't think there's going to be a great crash. We think there's going to be a great disappointment. We think a lot of people were missold a product. We think a lot of people are just going to be greatly disappointed because the funds that they're invested in are going to be on the back foot and can't be aggressively investing into a market that's more attractive to invest into.
I mean, when you think,
we think there's going to be sort of a slow fizzle away of performance here.
When you think about when the flows really started coming in through these channels that we're talking about, it was during 2021, right? Post-COVID,
right.
Zero interest rates.
Right.
That coincided with a lot of deals getting done probably in places where they shouldn't have. So I don't believe it's about a market issue. It might be a vintage issue. There's idiosyncratic issues. There's specific industry issues. But if you look at it, there's a high correlation between the deals that got done in that moment in time and the flows that came in. The reality is too much money came in too quickly relative to the amount of deals that needed to happen. That's reversing itself now. It's actually a healthy correction. And as an investor, both in core direct lending and capital solutions, I think it's a very good time. I think it'll get better because default rates are going up, recoveries are coming down. But that should probably put more pressure. But that'll get eaten up by the institutional dollars that'll come in.
Terry, from your seat, irrespective if it's on the credit side or the equity side, the one fundamental change is this software AI compression, whether it's SaaS apocalypse or something more mild. How are you thinking about underwriting or re-underwriting the managers in your portfolio today through that lens of what they've done in software?
Sure. So we're in a little bit of a fortunate situation because we've avoided all of that. We don't have a ton of just plain middle market direct lending funds in our lineup. We avoided the open-ended vehicles, and we tend to lean into more opportunistic strategies and investment managers that can buy that stuff when it becomes stressed. However, we do have some exposure. We didn't completely avoid it. We just go through and say, we realistically go through every single credit with the manager. We understand their understanding of where they're having it marked relative to the fundamentals. And you have to have honest conversations with them about it. And unfortunately, we're in locked up vehicles, right? So you can't do anything about it, but you can make a decision on the next fund based on what you're witnessing.
Yeah, look, because I think that there's kind of a range of outcomes when it comes to SaaS, right? Obviously, that's stating the obvious. And some companies don't need to exist, and they're going to go away, right? Some are going to be net winners, right? Others will see valuations depressed. And I question whether, well, I don't question, there's a difference between valuation and credit, okay? Every lender, let me say it the other way. People think that lenders, and you can back me up on this, Berger, most people think that lenders want companies that EBITDA goes like this. That's actually the second least desirable loan you want. The one you don't want is where EBITDA falls off a cliff. You also don't want where the EBITDA rises, right? You want one that bounces along, right? Okay. All right. So what happens when valuations go from 20 down to 10 and you're levered at 9 or 10? If you can still cover your interest payment and you still have some collateral EV coverage, you should be okay. Now let's go directly to the, go ahead.
Go ahead.
You go directly to the payout, and everybody thinks, well, if there's not enough collateral coverage, you got to take the keys. There's so many other levers to pull. You can bring in, Jonathan will pay down part of the loan, take an equity slice, right? A pref or a second lien or a sub piece. Absolutely. There's so many ways to exit a lower a business where the valuation has collapsed that I just wonder if there's actually going to be this SaaS apocalypse in credit. I just don't see it.
Yeah, I think one of the things we actually do look for is managers with workout experience, right? Smart money investors that have the ability to get into the trenches and have sharp elbows and could battle out a situation and try to preserve value for their investors. We look for managers that are, I'm going to be ageist here, but we like old people. We like people with gray hair, right? That are a bit grizzly and tanned. And I think a lot of people who are newcomers to the private credit market or very young have not seen a full credit cycle. They just simply have not. It's gone on too long here without having significant troubles and a significant downturn in the economy, with the exception of COVID. And so I think there's going to be a lot of problematic credits and portfolios that are going to be manned by people who don't have the experience to do so.
Totally agree. Totally agree.
There's a fair amount of confusion around whether valuation is a problem. some of these liquid vehicles, where are people transacting? Maybe it's less so in some of the drawdown vehicles and separate accounts. I'd love each of your perspective on what you're seeing in the weeds on valuation practices versus your perception of reality.
Yeah. Valuation practices are not homogenous. They're heterogeneous across managers. Managers have a ton of influence on what factors they weight in their private assets, whether it's credit or equity. And we see a huge dispersion of what people do to value their assets. And we see a lot of mistakes. We see a lot of stale asset prices, and that worries us, especially if they're vehicles where investors are buying in at an NAV a single day. We were talking about an anecdote before. We're invested in a credit fund, and I know they have a problem credit. It's going to not default, but it's going to breach some covenants, and it's going to have trouble. And so they're going to market. The manager's going to mark it down to 50 from 100 in the next quarter. But there are interval funds coming in buying that credit at par today. That's one example, but it's not the only example. And so there's no simple answer for how things are valued. It really depends on the manager.
Yeah, look, I think I agree with Terry. I agree with you. I think that valuation practices differ by GP, but I think there's a couple comforting themes and dynamics in the market. One is the fact that third parties are being used. Okay, so maybe the third parties have it wrong. I get that. But at least there's a third party looking at it, and they have collective knowledge because there's only about 4 or 5 firms that do this a lot. So they have some sort of read of the market. And I get the fact that the GP can argue with the value. I get all that. But this penchant, this fetish for instantaneous pricing, daily pricing, I think is pernicious. I think it's pernicious because it creates an illusion of transactability that isn't there.
100%.
Right?
I agree with that.
And you don't want a GP to sell out of a problem loan. Like your guys who are marking down from 100 to a 50. Okay, well, that's bad. I concede. But do you really, you don't really want that GP to sell out of that loan. You want that GP to do what you pay the management fee for, to have them work it out and take it from 50 back up to 100.
That's true. That's not my problem, though. My problem is when another investor is coming in. I feel bad for this investor. There's a huge transfer of value from me to that investor who's unknowingly buying that asset at par.
Yes.
I'm happy for them to come in. It's great for us, but because it dilutes us down. But that investor is unknowingly buying an overvalued asset. That's the problem.
Well, let's be clear. The transfer is from them to you, not the other way around.
Right. Right.
I think there's actually a wholesale change in what's going on with private credit, and it's still in the early stages, which is the secondary market of private credit. Private credit went from a market where it was marked at cost until something happened, and it's to a market where everyone uses third parties to market. Doesn't mean it's marking to market on a daily basis, but it's moving in a direction right now, particularly with the large alternative asset complexes, where there's a convergence going on between the liquid credit market and the private credit market. We're still in the very early stages. It's something that we should all watch very closely. I don't know where it's going to end, but it'll probably create more volatility and bumps in the road, which I think is healthy. I don't think it's a systemic problem, but there will be a convergence between and it's not just private credit, it's private market assets. I think we have to think about everything we're talking about in valuation for private credit. You could argue it's the same for private equity. Private equity doesn't mark the way public equity does either. And there's probably more volatility potential underlying private equity positions versus private credit positions. So I think we all need to just watch how private market assets are valued, but it's going to happen. It's the next stage.
It feels like you've got two sides of a market. So Jonathan, you said there are still net inflows coming in. All the papers would tell you retail money's coming out. What are the cases on either side of why should someone be looking at private credit investments today at whatever marks they happen to be?
Yeah.
If you've got a fresh pool of capital that's not already invested and pregnant with a lot of bad deals, it's a great time to be looking at it. You still get excess spread versus the public markets. Public markets are really, really tight, and the docs are awful. Now I'm talking about the loan market, not the bond market. They're pretty tight relative to private. The docs are worse than the public market. So there is excess spread to have, but you want to be a fresh You want to be fresh capital in. You want to be making new loans at these levels. You don't want to be pregnant with an old portfolio at this point.
Yeah, I agree. I think for with fresh cap, I mean, an existing portfolio, you really need to dig deep into what's in that portfolio and understand it. But for someone with fresh capital today, a good example is if you buy a newly issued, well-structured, first-lien private credit deal today with covenants, 50% loan to value, you're going to make close to an unlevered 9-10% yield. If you want to go get that yield in the liquid credit market right now, you're either going to buy something that's very stressed or unsecured, and the loan to value is going to be more like 80-90%. So there's a big difference. Now you're in a smaller company, okay. You're illiquid, okay. But the actual relative return is much better in the private credit market still than in the liquid credit market.
It's really interesting if you can access that private credit market today at a discount. That's really interesting. So it's either through secondary LP interests, secondary portfolio sales, or publicly traded BDCs that are trading at a significant discount to NAV. We've done a deep dive on this. We've run the analysis on the entire universe. We looked at everybody's portfolio, broken it down by what kind of securities they own and what is it senior secured, is it second lien, is it pref, is it mezz, is it equity? These funds have a lot of equity. These BDCs have a lot of equity in them that people don't know about, and pref. And you run through pretty draconian loss and severity scenarios based on where they sit in the capital stack over a 5-year period. And there are significant declines in NAV due to that, anywhere from like 20 to 40%, depending on the BDC. But a lot of these BDCs at 1.5 times levered, you think, and they can, 1.3 times levered, they can cover their dividend by about 1.5 times. They can accrete their NAV by about 3% a year on that math. A lot of these managers can make up for the loss in NAV due to the losses that we think are in the portfolio, and our assumptions are pretty draconian. And then you look at what price these BDCs are trading at relative to NAV, and there are some decent opportunities out there. So we think that's going to be a nice trade over the next couple of years.
And the public, we didn't talk about public BDCs, but they still represent, almost the same size as the perpetual private BDC market, and that market is, I think, shut in terms of them raising new capital because they all trade below NAV. Right. And so there's going to be a period, I think, of consolidation. We've seen it in the past. This is not the first time that there has been consolidation in the BDC world. We'll probably see smaller BDCs get bought by larger ones. Some will get liquidated, some portfolios will trade, and there'll be less managers and probably less capital in that segment until it's been retooled and can get to a place where it can trade it at NAV.
We also haven't talked about, the big whale in the room is the insurance companies, right? They're massive consumers of private credit, and they're still there, they're still active, they're still pushing forward. So there's always that kind of impetus there from the insurance companies.
Todd, what subsectors should people avoid?
Should they avoid? Ask me a different question. Look, I think, wow, that was a tough one. All right, so nothing revelatory, right? I think that the upper middle market has its stress. It's become a substitute product for the capital markets, right? And so they have to compete with high yield and broadly syndicated loans. And yeah, I'll leave it at that.
All right, let's talk about the potential reflexivity, particularly on the direct lending side with private equity. This gated and confused issue on the credit, all of that credit is senior to equity. How are you seeing your conversations with sponsors and what they're thinking and worrying about?
Well, the mark issue is worse in private equity than it is in private credit, because these credits that should be marked at 80, 70, 50, 40, the private equity marks have not come down commensurately, and they should. So there's actually a bigger issue there. And we're seeing a lot of private equity sponsors raise junior capital, very expensive junior capital, to either get distributions back to their investors, or to just buy runway for their companies. And it's just kicking the can down the road. And at some point, if growth slows significantly, there's going to be problems in the private equity world.
Yeah, I think that it's very company specific. I mean, we are seeing more sponsors handing keys to lenders. However, if you look at where do they do that and where don't they do it, even if they're over-levered in an over-levered balance sheet, if it's a company that's sustainable, it's not a binary outcome in terms of what could happen for whatever reason, they'll stay in, they'll support it. If it was something that, it's, completely disrupted by artificial intelligence, it might be that they're not going to put good money after bad. But you're seeing more of that. So there's, again, more dispersion going on in that market. And I would say the one area that has the least amount of capital, but probably the most demand for capital, is that space between private equity and core direct lending. So that, pref, mezz area, that is where issuers need the most capital and sponsors need capital, and where there's the least amount of capital available, to invest.
Todd, thoughts?
No, look, I think, when we talk about private credit, we talk a lot about direct lending, if not only about direct lending. And when I think about the opportunities available today, in addition to what Jonathan mentioned, it's just everywhere. You can find the need for capital in amazing niches, too numerous to name, and private credit's actually reaching those niches. It's not, an individual investor can't easily access those niches through interval funds and BDCs, but the institutions can, and I think that there's some really good returns and really good risk there.
So in the next few weeks, we're probably going to see a wave of media headlines about redemptions in the interval fund structures. How are you communicating with your investors, people you're talking to, about the difference between what you've just described and what's about to hit the headlines again and probably will for another few quarters?
We refer them to the white paper that we wrote called The Great Disappointment, predicting what was going to happen. It's on our website. We just say, just to remind you, we thought this was going to happen. However, it's called The Great Disappointment for a reason, because we don't think there's a great crash. So take a deep breath. The world's not ending. Lots of investors will be disappointed, but number one, you're fine because we avoided all that stuff. But number two, the market's not crashing, and we don't think the private credit market is going to take down the rest of the economy.
Look, I think private credit investing rewards patience. It rewards patience, and it rewards people who can look beyond the noise. And I think people who are patient and can look beyond the noise, if that loan gets marked down to 50 and you don't sell, if you got a good GP, that'll come back to 100.
That's why we don't want to have any asset-liability mismatches in the funds that we invest in.
Because in education, it's constantly talking to investors. I think that you've got two camps. One camp that's extremely concerned and thinks the world is coming to an end in private credit, and once you educate, they realize that's not the case. And the other camp is wanting to see a lot more of these opportunities. Based on everything we've said, there should be a lot more opportunities out there, and there aren't yet. And I don't think it's going to come in, it's not going to come in one big wave.
I agree with that.
It's going to be, it could be sponsor specific, it could be industry specific, it could be vintage specific. It's going to be slow, and it's going to take time. You just have to be in it and involved in it to get access. It's not going to happen one day and 1 year and then tighten up. But I think given that we're going to see continued rises in default rates, lower recoveries, it's not going to end anytime soon, but it's not going to be one wave of opportunities.
Okay. John, Todd, Terry, thanks. I think that's a great place to end.
Thank you.
Thank you.
Appreciate it. Thanks.